Go on, Scruffy, I'm ready.
You ready, are you?
I am.
Are you ready and waiting?
Yes, I'm sitting here waiting for you.
Yeah. Wasn't quite what I had in mind. Wasn't that when we were in the pub last night? We're doing a Q&A today. And a warm welcome to one and all. And for those of you not seen us before, my name is Langers. I am the very hungover Scruffy trader. And sitting next to me, as fresh as a daisy, is little Winky. Because as you can see, we're not exactly at home. We're out on a jolly in a hotel again. We are spending the spoils of Morningstar. So if you followed that series, you'll have seen I built up a small pot. And it's paid for us to have this nice little trip away. And if you look at our Instagram and Facebook, etc., you'll kind of see us messing about. But today, we're doing a bit of a Q&A. And it's a follow-on from last week's Coffee with Scruff. And this bit's going to be in two parts. Because we're doing a little bit of filming here at the hotel. Winky's going to ask me a few questions because she's got a few concerns about her own personal trading. And then I'm going to follow it up with the questions that you guys post when I get back in front of the computer screen. So, we'll start with Wink and see where we go. So, what do you want to know apart from how I maintain this fantastic physical physique?
Right, what's the hardest chart to trade?
The hardest chart to trade?
Yeah.
As in the hardest time frame or hardest product?
The hardest product.
The hardest product. Right, okay. It's actually quite a good subject and it can work in two ways. Because if it was the chart, personally I think the hardest chart is the 1 minute chart. It's too much noise. It's ludicrous. But when it comes to product, it's also about noise. Because a lot of them move so quickly, unless you have a massive bank account, it's going to destroy your account. And for me, the one that's the worst is the Dow. It's brutal. It will move so fast in one direction, it'll cast you off guard, but it can also retrace so far. You need very deep pockets in order to trade that instrument. So for me, it's the Dow.
So what's the easiest, or is it personal choice?
Well, there isn't really an easiest chart. They have certain characteristics, and what you would do is you'd look at the ATR, and that'll tell you how far a market can move. And for argument's sake, it moves 100 points, and you have an account that only has 100 quid in it. Well, if you're on the wrong side of it at £1 a point, you're going to blow your account up. So there isn't an easy one, but if you were looking to pick them out, I would, for Forex, I'd be looking at the majors. And of those, the ones that I find relatively peaceful to trade is Euro Dollar, Pound USD, nicknamed Cable, and Aussie Dollar. Reason being, they move in such a way that it's predictable. And they kind of behave themselves. They don't swing violently as much as, say, the Dow, as we just said. When it comes to indices, the easy one, so for argument's sake, the harder ones, like I said, with the Dow, but it's also the DAX. I trade the DAX a lot, but you need a big account pretty much to trade it or know what you're doing, because it can be brutal. But the FTSE's slightly gentler, but then if you want gentle again, it is the CAC 40. It doesn't move as fast, it's not as brutal, so it's a bit peaceful.
Right. So is there a good time of day to trade?
A good time of day trade? Yes. There are 3 major sessions throughout the day. You have what's called the Asian session, Now for me, we live in the UK. That starts at around midnight our time, and it runs through to 7 o'clock in the morning. That is very quiet, very peaceful. Then you'll start at around between 6 and 8 o'clock in the morning. UK time is a good time to trade, because it's as that session shuts, the Europeans are waking up and the pre-markets of London are getting ready for their 8 o'clock start. And you can see some nice movement there. I personally avoid the next hour. I don't like trading opens. But then from 9 o'clock to about 10:30 is a good time. The markets are setting up and they're getting ready. They're moving around a bit. So for me, between 6 a.m. in the morning, 10:30 in the morning with a break in the middle, it is a nice time to trade.
And is there anything you do to get yourself in the right mind frame?
Apart from chasing you around the house.
For
Yes, there is actually. Now this is quite a good question in the sense that it's individual for everybody. But that's what this series of questions was supposed to be about, mindset. And as you'll see when I go through the questions, wasn't really listened to because it was all kind of technical based. But that is a question in itself. Showed that they weren't listening to what I was saying. So mindset, getting into it, is actually doing your homework.
Right.
You see me at the charts all the time, hours before I'll take a trade. So what I'm doing is I'm looking at the chart and I'm calming myself down, so I'm not reacting to the chart, because that's a terrible thing to do. You know, switch your laptop on and just go, chart, oh, it's moving, I've got to get in. That mindset is a gambling mindset and also an urgency mindset. Whereas I take my time, and one of the questions touched on that, and I'll expand on it because it's about my day. The next part is, anybody that's in the Discord will certainly sort of shout this one out. I listen to awful music. Well, I don't think it's awful. I love it.
It is. It's bad.
What?
It is bad, your music.
It's not. It's brilliant. Who doesn't like Wonky Donkey and Bucks Fizz? I mean, maybe I'm wrong here, but it's fantastic. But I listen to it on purpose because it calms me down. I love music. I've got my toys on my desk, and I know people say I'm a child and I mess about too much. That's what calms me down. It takes my mind off the charts. All these that have a pop at me, they never make any money. Not one of them. And I'll trade against anyone, any day, any chart. And I'm not confident I'm prepared to do it. So can they say the same? No, but they'll point the finger. But when they are pointing the finger, it agitates me because they're having a pop. So I need to calm myself down a little bit, because if I go into the markets and I'm angry, I'll make a mistake. So I'll put some daft music on, I'll have a cup of coffee, come and talk to you in the kitchen, and just sit back. So I guess that's the question. Just whatever calms your mind down, just do it. But do it for about half an hour before you trade, because then you'll be in the right mindset to trade. You're not overreacting to what's going on. Does that make sense?
Yeah, great, yeah.
All right. So what we're going to do, we're going to toddle off and enjoy the rest of our day here at the hotel. And then when I get home, I'm going to go through your questions, and hopefully it might ring a few bells. So I'll see you when we get home.
Well, we're waiting.
Underground, overground, wombling free. Wombles of Wimbledon, coming are we. Hello, boys and girls. We back. Well, we're back from our little break. And what a grand time it was. Now, we answered a couple of questions from Winky, and now I'm going to fire this up and answer a few of your questions. And hopefully they're not the same as my t-shirt, because I put my emotions one on, because that is the key element of trading. If you can conquer your mindset, you'll survive. And that was the basis of this. And as you'll see from some of the questions, some of them just didn't listen to what I was trying to say, because the idea was around the psychology of trading, but some of them are kind of technically based, but I'm going to touch on them as well. But before we start, I'm going to put in a couple of my observations, which is from a couple of comments that came in that lie straight into the questions. Now I'll try and answer as many as I can, because there was quite a few, and I'll keep them as punchy as I can. So first of all, let me just fire up the questions in particular, because one of them was not on the Know Your Enemy video. It came from the Morning Star. Now the Morning Star series was where I was doing 1 trade per day in order to build a nest egg. All right, and it kind of shows something here. So the comment is here by Jethro. Now in the middle of it, he put it in capitals, and I really hope that is just to emphasize the comment and not shouting at me. Because if you're shouting at me and you're asking me for help, it'll never happen. Okay? Got to be respectful, you know. But the comment is, judging by the number of accounts you run in your portfolio, and then I'm hoping this is highlighted, you have your 5% as your own funds to trade. Does this just not mean I'm looking at the charts of opportunities all the time? Or words to that effect. Well, what you got to remember is, this is my job. And like any job, it's time management. Yes, I run multiple accounts, but it's not as difficult as you think. Day trading, I have 3 screens, 2 of which have my orders on, because I'm only really looking at 2 day trading accounts at once, and they are mirrored. So whatever I do on one, it's just put on the other one. Right? Very, very simple. One's mine, one's for the 5%ers. Right? So that bit's not too difficult. The other accounts I trade are swing trades, and I only look at them once a day, and it takes seconds, if not minutes, to have a flick through, see if it's ready, and check it. Right? So time management's a key. And my day works like this. Between 6 and 8 in the morning, I am looking just at one setup for one account, which is Morningstar. Right? So nothing to worry about there. All right, so it's quite easy, peaceful. And what I'm doing is I'm pulling myself around my cup of coffee. But while that's setting up, I'm also checking through my strength sheet to see what I'm going to trade that particular day. Okay, so it's all within that period. And once I've committed into a trade, I don't need a lot of management. I just let it get on with it. Now that runs up to about 8 AM. Between 8 and 9 AM, I'm not really trading. Not at all. I don't like to trade opens. I find certainly the London Open I don't trade. I find it quite vicious. I am then from 9 o'clock to around 4 o'clock looking for 1, 2 trades, and that's it. And they'll be mirrored on the 2 screens I've been talking about. Once that's finished, I am done. I'll then return to the screens at around 8 o'clock at night, and I will flick through my swing trades. And swing trades, because they're based on daily charts, doesn't matter when I do it, and I can do it at my leisure, place pending orders, and I just have to flash and look at it. See, there's a big myth about you're at the screens all the time. No, it's just time management, my friend. That's all it is. So it's not overtrading at all, not even close to overtrading. And that then kind of leads over onto where we come into Know Thy Enemy. Now there is a number of questions that I've marked up. As you can see, I've got them all wrote down so I can keep a run. But they're all here amongst this lot. Okay. And I will be starting with Mark's. But I want to pick up on this comment underneath that I saw by Tim. and then it highlights the other one as well, and I'll explain in a second. It says, I've seen him risk 1,400 to make something like 500. He's never heard of a trader be like that, never seen it in a book, and it sets his alarm bells ringing for him. Well, all I'm going to say to that is, and you've heard me say it in many videos, I don't believe in all of the crap that you read, and I certainly don't believe in all the crap that you buy. I trade my way. And my way is from a business point of view. I'm looking at what's called ROI, return on investment. Okay. Now, when you're in business, if you buy a product for £100 and you sell that for 110, you have increased your investment by 10%. That is the way I look at things. I then use Scruffy Madness, going backwards into that investment to increase the profitability of it. It's a different way of thinking, and it's because I wasn't trained as a trainer. Most of what you see out there is just recycled garbage that looks good, that is actually gambling. It's not trading, you know. When you see these things in, you only have to win 4 times out of 10. You are praying to God. You are hitting the right nail on the head because you're going in with a gamble. If you go in with an informed choice, you've done your research, you should be winning 8 to 9 times out of 10. And if you're not, you are not trading. You are gambling. And it's that simple, you know. I understand the risk reward that people talk about, but that is based on swing trade. Day trading is completely different. But then you're also assuming you know the size of my bank account or my trading account. You don't. You see, both of these comments, which is why I've pulled them up, are assumptions. And they're assumptions without knowing the facts. And that's probably why you fail. Because you're going in on the market with an assumption instead of facts. I go in, I know where levels are. I know what my pain threshold is. I know roughly how much I want to get out of it. And if it's inversed, it don't matter. As long as I know what I'm doing. And that's what I'm getting at. So when I see flippant comments like that, it really does kind of, I wouldn't say it winds me up, but it makes me sort of think, well, you don't really know what you're talking about. Because you don't know what size my account is. You see, you have a £3,000 risk on a 6-figure account. It's minimal. It's absolutely minimal. You have a £3,000 risk on a 50k account. It is minimal. Do you get my point? But if you're risking £3,000 on a 10,000 account, that's ludicrous. And that's what I'm driving at. You see, a stop has one job. It's to protect the account. That is it. Okay? And your profit is what you get out of it. Now, when you're in business, it's very rarely a positive risk reward. It's actually inverse pretty much all of the time. But then you'd have upsells and different things to increase that profit. Well, that's what Scruffy Madness is. It's an upsell on an original investment. It's a different way of thinking. So when you look at things, just try and look at it out of the box rather than what is sold to you. Because what you've got to remember is when you look at the industry, what is it? 70 to 90% fail. And why they're failing? Because they're learning from garbage that is, well, just rubbish basically. And that's why they fail. Is that not common sense? You know, surely if you're failing, what you're learning from can't be right in the first place. Just my thoughts. Anyway, so I just wanted to address those first. And now I'm going to kind of go through these questions. So we're starting with Mark. So it's a little salute to you. And his comment is, great content. Thank you very much. I do appreciate all that. If you're trading 50 pence and you have a stop of say 200 pips, At what point are you happy to walk away and pull the plug? Well, there's a lot more to this. You see, think of it as water. You've got to be a bit fluid with the way you look at your markets. I'm an advocate of a wide stop to start with. So I'll enter wide, okay? And it doesn't matter if it's 50p or 50 quid. It really doesn't matter. It comes down to common sense. So if it's going down 200 pips and I look at it and I think, I don't think I can afford that. If it hit 200, I've got two choices. I either half the position size or I don't trade it at all. Because your first question you need to ask before you go into any market is, am I happy to lose this amount of money? That's it. Wait, I'm going to rephrase that actually, because I don't think you ever lose money. I think, am I happy to pay for this trade? So in this case, 50p at 200 pips is £100. If you think £100 is too much against the account, because a stop has to be where a stop has to be, you know, fixed stops just genuinely don't work. You know, and if you're going in tight with a 10 pip stop thinking, well, I'm going to go 10 and get 3, you're going to find it's death by 1,000 cuts. I'd rather have one trade with 100 pip stop than take 10 trades with 10 pip stops, if that makes sense. So my answer to that is, it's a common sense question before I even go into the market. But at 50% to the stop, in other words, halfway down, I will be reassessing the trade. And if I think I'm wrong, I will kill it. You know, but up until that point, I'm happy to pound average in. And if I still think I'm right at that point, I'll continue to pound average all the way down to the stop, which increases the profitability. But it also means I'm reducing risk. But the trick with that is breaking your 100% into 20% increments, so you're never fully exposed at point of entry. Okay. So the next one is from Mark Isherwood. Okay, I'll salute you. My account is small at the moment and I feel comfortable trading one market. Yes, okay, I'll go with that. Now, whether I am comfortable trading more than one market is a waiting to see, building confidence and knowledge. I feel first and foremost, what size account would you recommend before you trade more than one market? Okay, well, there's a bit to unpack there, but I think the two elements is building knowledge and confidence is the first part. Well, knowledge and confidence just comes from experience. Okay, and if you are unsure of the markets, don't increase your position sizes. Keep it at the smallest position size possible till you feel confident that what you're doing is correct. But also don't chop and change the way you're entering the markets. Another detriment point which does shatter them, your mind and your confidence, is you see a system or you've made a system, whichever way, and it works okay for a week, but then you lose badly. And you think, oh, that's no good, I'll throw that out the window and try something else. And that might work for a couple of days, and then you lose badly. So you throw that one out the window. And you get yourself onto kind of what I call a treadmill of terror. In other words, you're going around in circles, just like a hamster on a wheel. And ultimately, it'll come down to, well, as you put there, your knowledge. You see, confidence is built by winning and being pretty au fait with what you're doing. Your knowledge, it can only be built from experience. But if you're jumping from one system to another, you're not going to have the experience of that system to trust it. So you're always going to be in a sort of poor confidence state. Now, trading one market is not an issue. And when I go to market, I'll trade only one instrument per day. So I might look across the markets, but I rarely trade more than one instrument a day. So essentially, I do only look at one. Account size, how long's a piece of string? As long as you can open up your positions for a market, you're fine. If you have a bigger account and you feel like you can open up a second position, well, again, how long's a piece of string? As long as your margin requirements are there, doesn't really matter. But what I will say is if you've got something like under £1,000 or $1,000, whatever, I'd only really be looking at one at a time till the trade is complete. Then do the next one and the next one. As a rule of thumb, I work on around 50p for every 500. That's kind of a rule of thumb. As your account grows, say you've got 10,000 plus, you can kind of go £1 for every 500, but I rarely go above £1 for every 500 of available margin. Okay, so that's kind of a, I hope that makes sense. I genuinely do, Mark. I'll try and catch up with that a bit more in the Discord as we speak. Okay, and if I butcher any names going forward, I really apologise. I will try my best. This one is housing, or at least I believe that's how it's pronounced. How do you determine your daily bias? I do it through maths. I have a math equation that I plug into my spreadsheet, and I do it every morning, and it's based on waves, strength of market, and a couple of other different things, and it spits out, it tells me the bias. If I wasn't going to use my equation, I normally either look at a 20 moving average or a 50 moving average on a day trade, and for a swing trade it is 50 and above. Okay, and it's a simple wave. If it's below, I'm selling. If it's above, I'm buying, sort of thing. But I find my bias sheet is pretty accurate, so I stick with that. Next one is by Baba Booey. That's a great name. I like that name. Just wanted to ask how taxation is going using funded accounts. Is it possible to get tax-free like spread betting? Right. For those who don't know, if you have a spread bet account, which is what I use a lot, it is tax-free, which is why you see me trade it a lot. It's very cheap into the market. It's very easy to work out your pricing because it's all price per point. So if it moves 10 points, I'm at £1 a point, it's a tenner. Very, very easy. So it's a lot easier than working out lot sizes on a Forex account. Now, on a funded account, such as the 5%ers that you see, as far as I'm aware, and I could be wrong, it is like a CFD. It is taxable. But that's certainly how it's wrote into my books for when I do my year end, because I work from tax year to tax year rather than sort of the way some people work sort of week to week. I'm just looking to make a profit in an entire year. And I have it down under the same banner as my CFDs, which are taxable. Okay. And then we've got Peter Burnfield. Okay. Right, now there's quite a bit to unpack with this one. Okay. With the constraints of the 5%ers boot camp, and just to clarify, if you don't know what the 5%ers are, they are a funded account where they will put the money up for you to go to market and you have a profit split. If you're interested, there's details in the description. Okay, and the boot camp is an evaluation period. It's a low barrier to get in. You do 3 challenges, and then they'll give you a 100k account if you're good enough. But if you think you're good enough, you can go live to market the way that I did and paid from day one. Okay, but the risk parameters and the way they work are very similar. Sorry, it was just in case you didn't know what the 5%ers were. 1% risk on any single trade. Would you suggest one trade at a time with multiple positions within the trade, Scruffy madness in brackets? Yes. Or would you look to trade more than one pair simultaneously? Okay. And then it goes on. I understand you look at risk in terms of money rather than percentage. So the max drawdown will be 1200 in the boot camp. And I feel that risking, say, 600 in a series of trade at 1%. Hope this makes sense. Great video as always. Thank you. Thank you. A lot to unpack, but ultimately it comes down to almost what we were discussing just a second ago. I would look at one instrument at a time. Why? Because the drawdown is relatively tight within the 5%ers. I might have plenty of margin because of the size of the account. But if it goes against me, and this goes back to the beginning comment as well about risk and reward and all that sort of stuff, I wouldn't put a massive exposure on the account. So I would trade one market and trade it well each day, and then compound the growth till I've got the drawdown account a little bit higher, and then I may consider opening up other positions, but that would be on the swing account where I do hold multiple positions at once. But when I'm day trading, it is one market at a time. Okay, then we go Franco Jefferson. Salute you, my friend. Know thyself and trust thyself. Are you still looking to use 2 structure points on swing trades? Yes, to a degree. I'll explain in a second. If on a swing trade you are entering on a lower frame, would there still not be the same points as your day trades, or do your swing trades from a higher frame? Sorry, that's 3 questions. No, I think I know what you're getting at. Now, I have a main strategy that the Scruffy squad know I use for swing trading. Now, my swing trades are from daily time frames, so I don't enter on a lower time frame. So the day trade and the swing are completely separate. They've got no symbionts at all, apart from the levels that I put in, where I may potentially be taking profit. Because those levels will be equal whether I'm on a swing or a day, because it's still the same instrument and it's still the same set of candles. The stop, however, is still based on 2 structure points and an ATR. And what it's for, going back to the start about the way stops are, a stop's primary job is protect the account. So why 2 structure points? Well, we know markets oscillate. They move up and down all the time. They will naturally test a structure point below. Why? Because it's what they do. If it goes down and tests it and then comes away, fine, your account's safe. If it moves through that and goes right the way down to a second structure point, there could be a possibility that you are wrong. And that's why it's 2, because I know it'll go for the first one. If it goes at the second one, I may have made a mistake here, but I've still given it enough room to breathe. And all I'm doing is I'll look at an ATR, see roughly how far a market can move within a day. And then I look for a couple of swing points, and then I hide the stop out of it. And it just allows the market to oscillate, because you'll see it can scream up, scream back 100%, down to 127%, and then go back up on its journey. You know, just market structure. Okay, so up back to Mark Rock again on the ball. What would be great if you could explain adding in trades like you did with Winky the other night? And if you were going for 10 pips on the DAX, how would you stage it? Okay. Now, adding into trades is personal choice. If a market goes for me straight away, I will rarely add into it. I will let it run. Okay. But with madness, what happens is you're staging in as the price goes against you. And I actually prefer that, because what I'm doing is I'm building a position. Now, within that, as we were talking about, the market can bounce up and down like so. And with the DAX, getting 10 pips is very easy. So it'll move up 10, come back 10, move up 10, come back 10, shoot up 20, come down 30. Well, if you go 10, take most of it off, leave a bit on, 10, take most of it off, leave a bit on, 10, take a bit off, leave most of it on, boom, 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 let it build up that way, so you're leaving little slivers on. That's what I think's the trade you were talking about. I often do that, where I'll take maybe 80-90% of the trade off if it hits 10 pips, and then leave a little bit running, and then all those little bits, while it's consolidating, will make a single trade or a single position, which is essentially being paid for by the bits I've cashed out. And then when it rockets up, I've got the money ready to go. But if it goes against me, well, they've already been paid for, so it's offset the risk as well. It's very difficult. I mean, Scruffy Madness is something I go through fully with the Scruffy squad. It's very rarely I'll show what that is in public, because it is the meat and bones of what I do and how I manage things. But basically, comes back to common sense. Start small, build into a full position, go into your stop. But if it is bouncing in consolidation and you can see it, just carve off, and leave a little bits running, and then make some money. Simple stuff. Okay, then we come down to Anthony Taylor. Okay, my friend. What is a good strategy to help hold on to a winner? Not necessarily a strategy, my friend. It is a trick. And it is simply a cup of coffee. Once you've put in your target and you've put in your stop and you're happy with it, switch the machine off and walk away. And where's the coffee come in? Well, you need something to do while you're not at the machine. And it'll stop you tinkering with the trade. But if you're looking for a strategy that holds on to it, it's always going to be a trend-based one. And trend-based, it's going to be something like a moving average. The simplest one in the world is the golden cross. And it's where a slow moving average is crossed by a faster one. The banks use a 50 crossing a 200. That's called the golden cross. And that'll hold for a long time on a daily. And if you've got the nous and the mindset to hang on to that, that'll keep you in the trade a long time. Okay. But for day trading, because especially when you're looking at 5-minute charts, etc., you'll see it go green, red, green, red, and it spooks you because you're seeing the colors flicking around all the time. So another trick is actually, if you are trading a 5-minute chart, once you've entered in and you've got your target point and you want to watch it, flick it onto an hour's chart, and then you're only watching a single candle instead of seeing them flick about. And that'll help you stay in trades a little bit longer as well. Okay. So, and then we've got John Harry Ford. Oh, hello. How are we doing? Brilliant video as always, mate. Pleasure. Always for you guys in the squad. I was wondering if it's possible to make a video of the pros and cons of both pound value risk and the same for percentage risk. Thanks again for what you do. The one and the same thing, it just depends on how you want to look at it. If you sort of go down the mindset of I'm a percentage risk trader and you're going on the narrative of 2%, personally, I think you're putting yourself in front of the freight train every time. Why? Because the big boys actually know this rule and they'll use it against you. Whereas if you're looking at money, they've got no idea how much money you're prepared to risk. But what they can do is they can work out the average account size of a retail trader. They know what 2% stop would look like for an account of such, and they can force the market into it. If you, however, have got a money idea, well, I'm prepared to £200, £1,000, £5,000 even. You know, and it goes back to what we started thinking. You've got a 6K account, or six-figure account rather, and you've prepared to go 5 grand on it, and you're going to stage into it for 5 grand for it to go forward. They've got no idea what that is, none whatsoever, because it's personal to you. So I'll try and put that into some kind of context of a video for you. But between the two, I do look at the money first, and couldn't care less about the percentage risk. I really couldn't. I think it's a fable, and it's there basically as a sales glitch, and I don't buy into any of that. So I'll do that for you. I definitely will.
They've done studies, 60% of the time it works every time.
Okay, and we're now down on to the last question. And the last question pretty much sums up everything that I've been trying to explain, and certainly what this video series was about. And it is a belter by Dwayne. Dwayne the dog. Private joke, boys and girls. He'll know exactly what I'm talking about. We had a great chat the other day, and I found it quite funny. Superb. Now I'm going to flick over his comment before I read it, just so you can kind of see it in case I read it out of context. Here it is here. And I think it is superb. I think it's summing up everything. He's hit the nail bang on the head. Okay. So the question goes like this. There's quite a bit to unpack, so I'll read it and then I'll try and break it down in a strange way and wrap this up. Know thy enemy. That would be me. Bang on. You, as a trader, are your worst enemy. You genuinely are. Okay. My biggest weakness is chasing the money, especially after a losing day stroke trade. I notice the next day I'm chasing and often looking for quick results. First failure. When you were less consistent, did you have a rule not to trade the next day or after a loss? Okay, I'll come into that one. And how would you advise to not chase money? Okay. I'm my biggest enemy by far. All too often, I've put myself out of trades, risking more than I'm comfortable with, and turned a bad day into a worse day. Wow. Fabulous. All right, there's a lot to unpack here, so we'll break this down. Okay, so we know from the first statement that you believe you're your own enemy. You are. So that is a demon and a battle you have to fight personally. We all have our different traits. Now, for me, that's why I have my toys and everything around my desk. You know, my Yodas, my Batman car, and listen to silly music, all of this sort of thing. Because I know what my fiddle points are, and they help me stop that. Right? So these are little things that you need. Okay. Now he says his biggest weakness is chasing money. Right. Now that is one of the biggest failures most traders have. Because they see the Lambo boys, they see all the glitz and the glamour, and they believe that's what it's all about. It's not. The first part of that is take the money out of the equation. Money has nothing to do with trading, not a bean. And I don't think a lot of people get that, and it's probably why I get slagged off all the time. Because it is process over money. Every time. We're looking for a market to move from this point to that point, or from that point to that point. That's it. That's the process. The money is the byproduct of that movement. Now, if you've lost money, it just means you haven't done your homework. You haven't analysed the chart. You've gone in on a whim, or rolling right back an assumption. Right? Now, when you assume something, a lot of the time you're wrong, because there's the famous saying, assumption is the mother of all ups. And it's true. So that's the first thing. All right? is don't chase the money. The money doesn't exist. You are looking for a process. Okay. And when you're looking for quick results, again, it's this greed, it's the fear factor, it's all of these emotions and the mindset. No, what's happened is the market's hurt you. And as a human being, we naturally want to retaliate. It's our sort of fight or flight instincts. Now, normally the flight part is when you're in a trade and you can see it moving against you, or you've got money on the table and it's coming back. You'll grab it and run away. But when it goes against you and it takes money off you, that's when the fight instinct kicks in and you want to retaliate. And the market's hurt you, so you want to hurt the market by quickly getting in and getting that back. Well, is that a wise move? Especially if your opponent is bigger and stronger than what you are. No. You're better off regrouping and sort of putting your tactical head on, let the dust settle, work out a better plan, and then engage on your terms rather than sort of just go blind faith into a fight against an opponent that's probably going to just batter you again. So that's the way. Take a deep breath and step back. In my case, I'll take a deep breath. I'll play my Batman. I'll certainly get Princess Leia out and sort of go downstairs and try and convince Winky into sort of putting that on, but doesn't really happen very often. But it's regrouping, it's taking a breather, it's stepping away. Okay. Now it says, when I was less consistent, did I have a rule not to trade the next day or after you lost? I'll come to that last. And how would you advise not to chase the money? I'm my biggest enemy by far. Okay. Well, like I say, when you're not chasing money, trading becomes a lot easier. Genuinely does. So for me, I'm looking for 1-2 trades a day. That's it. So that calms me down. And I'm also very good with my time management. So I have structured points throughout the day as to how I work. As I was explaining at the start, a couple of hours before the open, I'm just looking to see what's going on, picking out my best opponent. I'm looking for the best candidate, and then I'll watch that through the day and I'll trade it when it's ready. So patience is the best thing there. But for rules, it's not so much from when I was less consistent as more from when I was stupid, I think is the word. My trading came from a different platform to what most people that you see on YouTube did. I didn't come into it because I saw a YouTube video. I came into trading not even knowing what it was. It was just a natural transition from the business that I had. But I kind of figured out that I used to trade for the company of day charts and weekly charts only. I had this stupid idea that if you're trading on a 5-minute chart, obviously you get quick returns. And it's just a fallacy. It just doesn't work. You've got to look at the higher time frames and then use your lower time frames as your sniper points to get in at like a more refined entry. But when I was stupid, I used to trade multiple products at once. Why? Because I was stupid. And I would essentially overtrade, I think is what we're getting at there. And I learned a lot of lessons through that. And I figured out that I should really just be concentrating on one thing at a time, just like I would in the factory. If I had a particular task, I would put my energy into that task for that allotted time, complete it, and then I would do my next task and my next task and my next task. And then I would structure my day, whereas my trading, I would have a trade here, a trade there, one up there, and I make an ass of all of them. But when I looked at one asset and just stuck with it for the day, I found I was better. But I also got cocky, and I did quite well. And then I placed a trade that was stupid, beyond belief stupid. And it's the biggest loss I've had in my trading career, or the biggest loss of my personal trading career. And it was a hefty account that virtually blew the account within 4 days from one trade. And it was a big amount of money as well, a big amount of money. And basically what happened was I traded the DAX with too big a size. I decided to go off on a jaunt to sort of Portugal for 3 days or something like that. And I never placed a stop because I thought I was right. And I weren't. I was wrong. I was completely wrong. The market gapped up on the Sunday night because of a French election. And not only did it gap up, it didn't fill the gap. It kept on going all day on the Monday and the Tuesday. And by the time I got back on the Tuesday night, the account was gone. It just couldn't take it. It wiped it out. And from that point, I knew I had to change. And I mean, we're going back a long time now. I mean, this is long time. But I wrote down less is more. And that was one of the first things that I would see when I switched the screen on. And it all culminated from seeing multiple assets being traded and making an arse of it. And then this one that blew my mind out. Now, I'm still an advocate of wide stops, but I build into those stops. I never go into market at 100%. I'll go in partial position and build into it. And the profit is whatever. But that is kind of the rule that I put in. And it's also, it's one hit wonder. If I'm trading, I'll either win or I'll lose on the day. And if I lose, I won't go back to market. I am done till the next day. But when I go back to screen, it was just a bad day in the office the day before, and it's gone. I can't change it. I can't replace it. I just have to trade now what's in front of me. And that's it. Just like a game of golf. I like to play golf. I can have a bad hole, but the rest of the course is brilliant. It's just got to recompose yourself and start again. So that's that. So I hope all of that made sense in my strange, scruffy way. Do keep your questions coming, and do keep your comments coming. I do enjoy them, and I do try, and well, I don't do try, I do answer every single one that comes in. If you agree with me, great. If you don't agree with me, fine. If it works for you, but don't stress it. Never stress it. You know, I don't sell courses, so I've got no ulterior motive here. I do YouTube because I enjoy it. It's a hobby that helps me settle my mind. Not all the time, because sometimes I get out me box, because you do get some strange people on this planet. But ultimately, I do enjoy it, and I love the community that I built with the Scruffy squad. They're a great bunch of guys, and trading is what pays me. So that's it. It's, if I was to leave a single word of advice as we wrap this up, it is take process over money every time. You know, don't be frightened of a wide stop, and don't be frightened of your trade, because if you are, you've already lost. It's not the right trade. You should be willing to pay for your loss. And if you are losing, it's just a paid lesson and not what to do. Journal it, understand why you lost, and move on. And then tomorrow, you've got that written down. And if you see the same criteria, you've got a fair idea what's going to happen. Simple stuff, guys. So as always, trade well, keep your risk managed. But above all, do what you love, and the money will follow. See you all in the next one.